Hey everyone, I hope you're all doing well out there. This is your July market review. So, for those of you that are new to watching these, my name is Dan Westfall. I'm a certified financial planner. My company is Client Focus Financial. The reason that I put these videos together each month for my clients is to give them the straightforward information about what's going on in the stock market and the economy, and ultimately how that affects their investments that I'm helping them manage. So, quick recap here. We're halfway through the year. The S&P 500 right now is up right at about 10% for the year, which is a great rate of return for an entire year, let alone just the first half. So definitely a good thing. Rebounded a lot from where it ended after the end of the first quarter. As you can see on that chart, we were down at one point almost about 7% at the very end of the first quarter, and then made a really big rebound after that. So big reason for that was earnings. So company earnings had gone up a lot, and there was a lot of profitability. It was one of the most profitable quarters in stock market history. There's a quote that in the Wall Street Journal, a writer for the Wall Street Journal, Spencer Jacob, had said in there, the first clue about how unusually profitable the quarter has been is that analysts raised their earnings per share forecast for the S&P 500 by 3.4% since the end of March, according to FactSet analyst John Butlers. Analysts typically lower them during the quarter, which helps companies later report a positive surprise. The average reduction has been 2.7% over the past 40 quarters. So that's 40 quarters is basically 10 years. So it's a really big deal, the fact that not only are analysts looking pretty positively at where the quarter's going because of them raising the overall estimates, but companies, the reason that they're doing that is because companies have been so profitable. So definitely a really good sign overall. Getting into kind of some of the changes within the portfolio, the largest position within the sector rotation strategy that I manage that is a big part of everybody's IRA that I'm managing, whether that be 100% if you're more conservative, or a little bit lesser, 50% maybe if you're more conservative, versus the younger people that are a little bit more aggressive where it's 100%. The top holding in there is the semiconductors position, which through June 10th had become about it was like 42, 43% of the portfolio. On June the 10th, I trimmed it back to about 30% of the portfolio, which you can see in this chart. One of the dips there was June the 10th timeframe, and it's a little bit higher today than where it was at that point, but it had gone up a lot and it's come back down here just the last couple days. I'm shooting this July 3rd just to give you a reference point. So the first couple days of the quarter here, July 1st and 2nd, semiconductors are down pretty big so far. But what I did is I took a portion of that, a large portion, about 9% of that, and bought back the healthcare sector. So healthcare, if you follow these videos or just follow your portfolios, or if you're a client, was an area that I had cut way back in the beginning of February, when healthcare at the time was around like 150, 155 in that range. So what had happened after that, and at that point in time, I had put that money in energy, and energy had really taken off at that point. But so healthcare is a large sector within the overall S&P 500, and it's an area that when you cut a part like that out, if it really takes off, the overall S&P can go up a lot, and a portfolio can lag because it's not in there. So I had added it back, not just because it's the second largest position in the S&P 500, but because it's just a huge part that is trending right now. So I added that back on June the 10th, taking some of that money, which at the time the price for the healthcare sector fund was about 153. It dropped below that to in the 140s before rebounding to where it is as of today at 163. So up about 7% since that trade's happened. Definitely a good trade overall with how healthcare's been doing. But quick update with that specific position within there. For the clients of mine that are a little bit more conservative, I know a lot of times when I'm doing reviews, I'm talking more about the stock portion of the portfolio, but if you're a client of mine and you're a little bit more conservative or you're actively withdrawing money from your portfolio, you're going to have a little bit more of a conservative part of the portfolio that typically an advisor would use bonds to, have that portion of the portfolio invested in. I look at bonds as a dead asset class right now, and I have for really a handful of years. I've been using what are called options-based strategies to still help mitigate the risk of the stock market, but give more upside than a traditional bond portfolio could. So one of the charts I have here is just showing the three positions that I mainly hold for options-based strategies versus bonds, an aggregate bond index. So you can see the total return for the aggregate bond index, that's in the darker kind of purple line there. It's less than about 1%, about 0.7% for the year so far, versus the options-based strategies. They vary from 3% up to 5.4% for the year. So definitely a lot better returns there, which if we look at this is about 30 to 35% for somebody that's a little bit more conservative in your portfolio. So just having an average of, say, about 4% return versus the 0.7% return, that adds a lot to the bottom line of a portfolio, on top of the sector rotation, which is the more aggressive part, which thus far this year has outpaced the overall market by about 4%. So on both fronts, those are both hitting both the conservative part of the portfolio and the more aggressive part, which I love to see, obviously, because I'm doing the management for it. So it's definitely a good it's a good feeling for me when I'm doing things that are working out, that are going well. So the reason for that, obviously, these options-based strategies, they're linked to the indexes. So the two of them that are buffered strategies, they are linked to the S&P 500. The one in the green there, that's linked to the NASDAQ 100. So all three have done really, really well. So and they have different kind of like components of risk management, of downside protection to the market. So that's why I use them as a replacement for bonds within the portfolio, just to help with mitigating the risk of the market in a different way versus just dropping money in bonds and using that as the way to offset the overall market fluctuations. Because bonds, as you can see, there was a drop off in March. Bonds still dropped off along with that, not to the same degree, but they're still selling off with it. So not something that if I'm going to be correlated to the rest of the portfolio, I'd rather just make more money on the upside and still kind of mitigate the downside in a different way. So that's a year-to-date number. This is going back since the beginning of 2025, which is when I added that NASDAQ 100 position to portfolios. So you can kind of get a good glimpse of like how this is really done, not just in a microcosm of just this year, but stretching it back here over the last year and a half, how it's done. So bonds we're up 8%. Versus the two S&P 500 options-based strategies were up 15 and 17 respectively, and then the NASDAQ 100 managed floor strategy was up almost 22%. So those have done really, really well over time there, which is just to be expected with how they're supposed to function. Part of the reason why I have them in the portfolio in the more conservative way. So those are just some of the charts. I want to give you guys a quick update. I know we're hitting holiday weekend here, so I hope you guys have a great 4th of July weekend. If you'd like to connect with me, I know I'm getting together with a lot of my Pennsylvania clients that I typically get together in person with here in a couple weeks. If you'd like to get together, feel free to reach back out to me, and we can coordinate some time to either just catch up over the phone, Zoom, or possibly in person, depending on our, where you're at location-wise and things. So, but if I don't connect with you this month, I hope you guys have a great month, and I appreciate you all taking the time to check me out. Until next time.